Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Stock is the most discussed and arguably most popular security in the entire world of investing. The stock market is often cited as a measurement of the economy's health and is directly tied to people's financial goals like saving for retirement or for their child's education. But what exactly is common stock? Let's explore that. It's an equity investment, another way of saying it measures ownership in a company. Let's say, for example, that you own one share of Netflix stock. As of mid-November 2020, Netflix was trading right below $500 per share. By spending $500 on one share of Netflix, you become a part owner of the company. But the key word there is part owner. Netflix has nearly 450 million shares outstanding, so by owning one share, you have a very small stake in the company, but still you're a part owner of Netflix. And of course, the more shares that you gain, the higher your stake in the company. There are two primary ways to make a profit on a common stock investment. First, we'll talk about capital appreciation, which is also known as growth, or sometimes referred to as capital gains. Each of those terms is just a real fancy way of saying buy the investment at a low price today and sell it at a higher price at some point in time in the future. While spending $500 on one share of Netflix stock seems expensive, and it is, most stocks trade at $100 or less in the market. Well, what if you could sell that investment in the future for $2,000 a share? With only one share, you're looking at a $1,500 gain or a 300% return on that investment. If you owned 100 shares, you're looking at a $150,000 gain. The more shares you have, the larger your stake, and the more gain potential you have with that investment. But what if Netflix goes bankrupt? There are a long list of companies that at one point in time were prominent or maybe even the kings of their industries in the past that eventually went on to go bankrupt for a number of different reasons. There's no telling what happens in the future with a company or with anything. So, could a $500 investment in one share of Netflix stock eventually plummet to zero if the company goes bankrupt? That's certainly possible. And in that case, you are locking in your maximum potential loss. The most an investor can lose if they're buying stock is their investment. And of course, the larger your stake, the more you can lose. So for example, if you owned 100 shares of Netflix stock, you're looking at a $50,000 maximum loss if that occurs. The bottom line is the larger your stake, the more gain potential, but also the more loss potential you have with your investment. While the profitability and success of Netflix will influence its stock price, ultimately there's only one thing that determines where its stock price goes. And that's demand. The stock market, which is a general term for the many exchanges and platforms and places that investors trade stocks with other investors, there are billions and billions of shares that trade in the stock market on a daily basis. On November 18th, 2020, 4.7 billion shares of stock traded on NASDAQ, which is one of many places where stock trades in the stock market, for a total of over $200 billion. Netflix stock is listed in trades on NASDAQ where over 6 million shares are traded on average on a daily basis. If there's more demand from investors to buy Netflix stock, we will see its market price go up, and vice versa. If there's less demand, maybe another way of saying that there's more supply or there are more investors selling Netflix stock, we will see its market price fall. The profitability and future outlook for the company will influence how investors feel about the stock, which will ultimately turn into more purchases or more sales on any given day. That's capital appreciation, also known as growth or capital gains. And to summarize that, investors can make a profit on stock by buying it at a low price and selling it at a higher price at some point in the future. Every single stock out there is eligible for capital appreciation, which is why it's the most common way investors make money on their stock investments. The other way to make money on common stock is through cash dividends. When a company makes revenue, it first must pay for its expenses. These expenses include cost of goods sold, employee wages and salaries, operational costs, infrastructure costs, debts they have outstanding, and even taxes. Once a company has paid for all of its expenses, it has net earnings, sometimes referred to as net profits. Companies have a few choices in terms of what they can do with those net earnings. They can retain those earnings and spend that money in the future, typically on expanding the business's operations. It can also send those earnings to its shareholders in the form of a cash dividend, or a little bit of both. Companies like Netflix are known as growth companies that, generally speaking, do not pay cash dividends. And in fact, Netflix has never paid a cash dividend to any of its shareholders in its entire history. Every dollar that Netflix makes in earnings, they spend on licensing new content, producing new content, marketing, hiring new employees, etc. They believe they can provide more value to their investors by growing the company, which will allow those investors to sell their stock at a higher price later. This is very common for growth companies. And some other examples of companies that are similar in this respect are Amazon, Tesla, Zoom. None of these companies have ever paid a cash dividend to their investors, but they're hoping to grow their business so again, their investors can sell their stock at a higher price. That's capital appreciation. Larger, well-established companies that are generally speaking beyond their significant growth phase are the ones that pay cash dividends to their investors. McDonald's is a good example of one of these companies. McDonald's has been in business since 1940 and saw an explosion in their growth in the 1960s in particular. After several years of explosive growth, McDonald's paid their first cash dividend in 1976 and has been paying cash dividends on their common stock ever since. In 2019, the company paid $2.41 per share throughout the entire year when they paid 4 quarterly dividends to their shareholders. If an investor owned 1,000 shares of McDonald's stock throughout the year, they made $2,410 in cash dividends alone. Even if the company's stock price was flat in 2019, which it wasn't, the investor would still make a profit on the cash dividends alone. Companies that pay cash dividends on their common stock provide their investors 2 ways to make money on their investment: capital appreciation and cash dividends. On January 2nd, 2019, which was the first trading day of the year, McDonald's stock opened at $175 a share, and on December 31st, 2019, it closed at $197 per share. This resulted in $22 of capital appreciation gained throughout the year. So add that on top of the $2.41 per share in cash dividends, investors overall made a pretty decent profit on McDonald's stock in 2019. An investor owning 1,000 shares of McDonald's stock would have made $24,410 in overall profits with the two combined, capital appreciation and cash dividends together. That should give you a good idea of what common stock is and how it can provide a profit to its investors.